Europe's financial crisis and subsequent bank and country downgrades have cast the spotlight on credit rating agencies. MEPs complain of their excessive influence and less than perfect methodology and are pushing through a new set of reforms and regulations. It's the third in 3 years. EuroparlTV goes to the world of high finance to explore the arguments. The fast and furious floor of the London Metal Exchange. This is one of the last places in the Western world where trading is done manually, a quaint throwback to the days when metals were bartered around a ring in coffee houses, but with the frantic speed and big numbers of today. Like all big financial institutions, the exchange and its investor clients are locked into modern globalized systems, at the heart of which is a body of agencies that many in Europe believe have become too powerful. They're credit rating agencies, depended on by banks, corporations and governments the world over. But a string of recent downgrades in Europe has outraged some in the EU and led to calls for deeper regulation. It's designed to improve the quality of ratings, remove conflicts of interest and try to prevent Eurozone crisis management from being hijacked by randomly timed downgrades. With 75% of the financial services conducted in Europe done here in the markets of London, it's not difficult to find resistance to regulation. Change is a threat to revenue and livelihood, and, as many argue here, particularly damaging if it's rushed and poorly thought through.
I think there's a big risk that this latest set of proposals could be very damaging to the growth. Some people forecast that Europe, over the next 5 years, in the non-financial sector, will need something like €1,500 billion. The thrust of policy making, therefore, in our view, should be very much towards making capital markets financing easier, not more difficult.
There have been no fewer than 3 sets of legislation designed to curb what many in the European Parliament see as the undeserved influence of the big 3 agencies. Martin Wynne speaks for one of them, Standard & Poor's, and defends their record.
We don't have a political agenda. We're not in the business of advising governments or telling governments what they should or should not do. What we're looking at is the impact, in our view, of policy making on creditworthiness.
He says the new legislation could affect recovery and growth.
There is a concern that some of these measures will actually disadvantage European companies, for instance, who use credit ratings to help access much needed funding in the capital markets.
However, end users like investment manager Rob Ford at 24am are not so convinced.
Maybe they're perhaps a bit too big and a bit too macro. Not everybody can be an expert in everything, and I think that means they have made and they will continue to make mistakes. Given the current crisis, there is perhaps an opportunity for someone new to come along, perhaps with some sponsorship from the regulatory authorities, and to make a difference.
Which brings us to the central German city of Düsseldorf, where finance entrepreneur Markus Krall is doing just that, setting up a new European credit rating agency to compete with the big 3 here in his apartment. By the end of the year, Dr. Krall says he will have a credit rating agency up and running and based in Frankfurt with startup capital of €300 million. He's already in close contact with European ratings regulators.
Ratings are created on an expert-based qualitative analytical approach. And that qualitative analytical approach is open to a lot of degrees of freedom. We are proposing to start ratings in principle with a mathematical empirically tested model, and then to complement that with qualitative analytics. We will put that on an internet-based platform. So ratings will not be performed and published, they will be produced in public, and that's a big difference.
When you think about a new credit rating mechanism in Europe, it's instructive to observe the American experience, especially after the disastrous AAA ratings of spurious financial products. There, many are saying not much has changed. The banks are still cozy with the agencies, and they're still operating on outdated models. As in Europe, many American legislators are saying it's time for new rules. It's not, they say, about meddling in the market and stifling competition. Rather, it's about creating the conditions for growth by allowing capital markets to function consistently and confidently.
The critical element here, if we don't want to see further downgrades, but if we want to restore trust in the ratings of the Eurozone countries, will we see an intelligent political decision-making that shows the markets that there is a way out of this crisis.
That there are stormy times ahead in the Eurozone, no one doubts. But European politicians are picking their way slowly through the crisis, using the new tools at their disposal and attempting to bring those not at their disposal under tighter regulation.